Billy, look, your thoughts on the session today?
I think if we have to look at the market today, we saw three main impacts. One was the number of profit warnings we saw coming through to the market. Secondly, talk that the yield play is dead. And thirdly, we saw a rising Australian dollar. So all in all, the Australian market down by 0.6%. The profit warnings coming through from that mining services area, again, we saw both Transfield as well as Fleetwood losing around about 25% in value. Boart-Longyear also coming out with a profit warning, but the stock actually up by 0.6%. And then talk that the yield play may be dead. We saw Richard Coppelson coming out to say that perhaps that yield play may be over, and that's on the basis that he doesn't expect any more interest rate cuts to come because of the lower Australian dollar and the possible change in government that we're going to see in September. And finally, the Aussie dollar very much in focus. We've seen a recovery during that Asian session. We're watching Ben Bernanke's testimony to the Joint Economic Committee and also the FOMC meeting minutes coming out in the next few days. So all in all, not a good session for the Aussie market, down by about 0.6%, and really looking at those profit warnings coming through from that mining services area again.
If we do believe, though, that the level of interest and activity amongst the yield playing might not continue at the rapid pace it has, do we start to look, or does the market, do investors start to look at some of those stocks that Jeremy mentioned that maybe haven't seen the type of frenzied favoritism that some of these yield plays have?
I guess if we have a look at the last week of trade, we're still seeing an environment where we're seeing stocks like Commonwealth Bank, Magellan Financial Group reaching all-time record highs, and indeed the market last week reaching the highest level that we've seen in around about 5 years. So while we do talk about I guess the yield play being over, it's been a fantastic run so far for the market. And I guess if we have a look at what's driven up this part of the market, it is the defensive areas. If we want to see another step in this market rallying continuing, really we want to start to see the resources starting to participate. But of course, that's where a lot of the volatility and the uncertainty around China is lying at the moment. If we have a look at the yield plays, yes, a lot of it has been driven by this search for yield and the fact that we are seeing interest rates falling here in Australia. But if we have a look at the fundamentals in terms of the businesses and have a look at something like the banks, it's very hard, I think, to take a bearish long-term view on the banks, given that we're at the lows of the credit cycle. And as we start to see that credit cycle improving, hopefully the domestic businesses of the big four banks also improve, and that the fundamentals should help to support valuation. So yes, based on where we currently are in terms of valuation, banks are looking quite expensive, but of course markets are forward-looking, and if banks aren't the most expensive at the lowest part of the credit cycle, well, when else are they going to be looking expensive? It makes sense that they look expensive when we do see credit conditions being relatively low. So I think the fundamentals should start to improve for banks once we start to see that credit cycle improve. But where we are based now, I guess they are looking quite expensive. But really, in terms of the Aussie share market, that lower Aussie dollar, I think, is a saving grace in terms of earnings, and we should start to see an uptick in terms of earnings, which hopefully should help our market.
Obviously, one sector we've been talking a lot about with the flurry of downgrade and concerning news coming out of them, Boart-Longyear the latest.
Boart-Longyear
actually had a pretty good jump. So I meant Fleetwood, I should say, yesterday.
Boart had a pretty good session despite its profit warning coming out, and I think that has to do with what's already been priced into the stock. If we have a look at Boart-Longyear, this is the stock price over the last 1 year, and you can see that since February we've actually seen the shares already declining by 60%. So a lot of it was priced into the stock, I think, already. We have a look at what Boart-Longyear has come out to say, that they do expect earnings to be on the lower end of analyst forecasts. And if we have a look at where consensus was, it was at $240 million in terms of EBITDA. If we have a look at the range, it was between $199 million to about $171 million, $271 million, sorry. So it looks like it's going to be more around that $200 million mark. It is off from their February forecast, which were around about $260 million. But the fact that the market had priced in a lot of this meant that Boart-Longyear didn't have too bad a session. But the stock is down 60% since their February update. The stock today up by 0.6%.
Is it one you